Warning: crypto bear market mistakes to avoid. A crypto bear market is the perfect time to learn, focus, and plan for the future. Numerous projects have failed because they weren't ready for a crash, but it's also an opportunity to keep your head down and work on your investing game plan. Hello and welcome to Tom's Do-It-Yourself Investing, a channel where we discuss personal finance tips, investing guides, real estate, and the stock market. Cryptocurrency veterans know that cryptocurrency markets are cyclical with bearish and bullish periods. Prices often rose by double digits in the bull market that began in late 2020 and ended in late 2021. Bear markets, on the other hand, may see prices drop by 90%, then another 90%, and so on. If you're trying to invest during the crypto bear market, don't despair. There are opportunities for everyone if you know what not to do. In this video, I will discuss some mistakes you should avoid in the crypto bear market. Without further ado, let's get right into it. For investors who are unfamiliar with cryptocurrency bear markets or experience them for the first time, making mistakes can be very costly. As a result, learning from those who have been through previous cycles, as well as spotting common mistakes in advance, could save both time and money. The following are some of the common mistakes traders and investors should avoid during a cryptocurrency bear market. Overtrading. The most obvious thing to avoid during a bear market is overtrading. If you're moving your money in and out of crypto every few days, you're going to be increasing your stress levels as well as lowering your long-term returns. You'll also be increasing the amount of taxes you'll have to pay, as well as lowering your confidence and willpower. You'll be more distracted, and it'll be harder to focus on long-term goals. Think about why you got into crypto in the first place. Did you want to gamble your money away and hope for a big hit? Or did you want to invest in something long-term? When you're overtrading, you are doing neither. Panic selling. There's nothing good about panic. Panic happens when we experience a combination of fear and anxiety, and it usually occurs as a reaction to something that is already dangerous. As a result, we are more likely to lose control and make irrational decisions. An example of panic selling is when cryptocurrency is sold off in a widespread manner because of fear, rumor, or an overreaction without rational or thoughtful analysis. Cryptocurrency investment should be based on sound, objective reasons rather than emotional motivations. Bitcoin, for example, has historically appreciated over time as a store of value. When fiat currencies suffer from high inflation, they tend to lose value more quickly, so many people invest in them to preserve the purchasing power of their funds. When this is the main reason for investing, one should have a long-term view, and the only reason to sell would be if the narrative shifts fundamentally and Bitcoin no longer fulfills its original purpose. In practice, we see that many people sell their Bitcoin when the price drops. At this time, a lot of people forget that Bitcoin is also primarily considered a risky asset. This leads investors to liquidate Bitcoin first before liquidating other assets that they believe are safer during times of economic turmoil. Sometimes, the price goes down more aggressively as a result of this. Many investors panic during these aggressive sell-offs. The most common mistake is likely to be this one. It's important to remember that no asset rises straight up. It's true that Bitcoin's price is more volatile than, for example, the S&P 500, but it has also historically risen. In spite of the vicious corrections, it's important not to lose sight of why the investment was initially made. Not taking a profit. One of the biggest mistakes you can make in a bear market is not taking a profit on your successful trades. Don't be greedy and decide to hold on to every last coin. Instead, take profits when the price is high and put those profits back into new crypto. This way, you'll be able to diversify your investments automatically, and you'll also be able to avoid single bets that could prove too risky. If you sold all your coins, you won't be able to diversify your portfolio, which means you're taking more risk than you need to. You also won't be able to reinvest your profits in new coins. A bear market is the perfect time to take profits on your successful trades and reinvest that money into new projects that you think have potential. This will help you avoid putting all your eggs in one basket. Trying to time the bottom. One of the most common mistakes newcomers make is trying to time the bottom. Many people believe that Bitcoin still has room to fall and will buy when it goes further down. One outcome could be that Bitcoin falls, but no one buys because they believe it will fall further. The other outcome could be it never goes down and they don't buy expecting one last leg down. However, take this into consideration. Think of Bitcoin trading as $10,000 and you believe it will crash to $8,000 in another 20% crash. Then the unimaginable happens where Bitcoin goes on a parabolic bull run reaching $100,000. If that were to occur, you would be saying that a possible 20% crash was not worth waiting for. People believed that the worst was yet to come when BTC fell below 4K in March 2020 during the crash, when global lockdowns and a pandemic threatened the world. A year later, Bitcoin topped 69K after a rampant bull run. Market predictions are all educated and informed guesses. No one knows where it will go next. For non-professional traders, a dollar-cost average strategy is a great choice. The dollar-cost average strategy is even better if you do it on the way down. You invest your money on a regular basis, for example, once every 2 weeks or once a month, by breaking it down into smaller batches. By doing this, the average price between all entries will be obtained and the risk will be minimized. Reinvesting without a plan. One of the biggest mistakes that new crypto investors make is that they reinvest their profits without a plan. They try to put all their money back into crypto, but they don't know what they're investing in, or they're investing in projects they don't believe in. It's important to have a plan on what you're investing in, and you should only be investing in things you believe in. You should also have a plan for what you'll do with the profits from those investments. You should be putting the profits towards other projects, towards your savings, or towards paying off debt. Not maintaining your financial stability. It was in April and November 2021 that most investors who invested in crypto in late 2020 achieved their biggest gains. However, the current situation of cryptocurrency is different now. Investors shouldn't trade or invest in hopes of recouping what they lost during the bull market, as the comparison is inherently wrong. Despite how appealing it might be to attempt revenge trading by engaging in extremely risky trades, revenge trading may go terribly wrong. In a bear market, staying financially stable is essential, and staying out of leverage helps as well. A common strategy in crypto markets is to use leverage, but doing so in a declining market is a risky move. Moreover, even if you manage to accumulate a substantial position, you have little chance of maintaining it. Not reinvestigating new and old projects. Another mistake investors make is not reinvestigating new and old projects. In the crypto world, there is always room for innovation and experimentation. It is common for a number of projects to be created, vanish off, reinvent themselves completely, flourish, and disappear. Crypto projects often have tokens associated with them, and their success is often correlated with their token performance. It is just a matter of watching new and old projects during bullish and bearish runs. As the projects evolve, you'll have to revisit them now and then to make sure they're still relevant. Not paying attention to mental health. Another major mistake that many crypto traders make during a bear market is not paying attention to their mental health. Crypto trading is stressful, even at the best of times. And it's even more stressful during a bear market because you're not making as much money, you're worried about your investments, and you're trying to do everything you can to get out of the bear market. All these stresses can lead to a buildup of stress, anger, and frustration. It's important to manage these emotions. Take time off, go for a walk, meditate, or do whatever helps you relax. A lot of traders don't take care of their bodies, which means they're less capable of dealing with stress, and they're more likely to get sick. Make sure you're eating healthy foods, getting enough sleep, and taking care of your body, because stress is a killer and it can be avoided. Once you take care of your body and your mental health, you'll be prepared to take on the challenges and manage your finances and investments better. The crypto bear market is a time to learn and grow, but it's also a time to make sure that you don't make the same mistakes that so many others have before you. It's important to avoid overtrading, panic selling, not taking profits, trying to time the bottom, and other mistakes that we discussed. Please feel free to share any of your experiences in this bear market or in the past in the comments below. If you haven't subscribed yet, make sure to subscribe and hit the bell icon. If you found this video helpful, give it a thumbs up, and don't forget to share this knowledge with those who might find it useful. I will be back with more videos. Until then, take care and stay tuned.